You're listening to Questioning Your Sense, where you get real-world, pragmatic tax and financial advice for business owners, entrepreneurs, and independent contractors. Here are your hosts, Kevin Molen and Charles Steinmetz.
Hey folks, welcome to Questioning Your Sense. I'm your host, Kevin Molen. Today we actually have a special guest with us, Peter Huynh. Peter, thanks so much for joining us today.
Absolutely. A pleasure being here at the Molen Associates, and thanks for the invite.
Yeah, for sure. You doing all right today?
I'm doing good. Yeah, a little tired from our trip from yesterday, but yeah, flew in from Atlanta. But I'm glad to be here this morning and be able to answer some of your all's questions and chat a little bit about the topics you have in mind.
Nice. Last time I was in Atlanta, did some pretty good fried chicken. I'm looking at our producer, Clark, because he and I actually were there together. Okay, so kind of in a traditional sense, I know this is your first time joining us, but usually we have a segue, and so we talk about something personal or professional, not necessarily relating to today's topic, to kind of segue us in. And so usually I ask our co-host Charles to start, but as you are our guest, I'll go ahead and start today. We recently got back from a trip in New York, so I lived in Western New York for a couple of years. I'm a city boy, Houston, Texas, born and bred, lived here almost my entire life. A couple of years I lived in New York, and I loved it. You can't find decent Mexican food up there to save your life, but the pizza, the subs, the wings, very good. And so I had a week of subs and pizza and wings, and it was really fantastic. So,
been into a little Italy up in New York, Manhattan?
I have not spent very much time in the city at all.
Okay.
So I lived in Rochester and Buffalo. So I was in Western New York, not even upstate like Syracuse, but Western New York. And so I haven't spent very much time in the city.
Gotta make a trip.
Yeah, for sure.
That's great.
So how about you? Is there anything you wanna tell us personally or professionally?
Yeah. So personally, insofar as the career that I do, again, it's who I am as I'm a VP for Medicare operations at Trusted Benefits Group, and personally, prior to all of the insurance world that I've been involved in, I was a missionary for almost 20 years. Traveled abroad and started when about high school or so. And during those 20 years, I acquired a lot of skills, a lot of languages and whatnot. And it really serves into what I'm doing right now. You can't make a career out of being a philosopher, but you can think by coming and using those skills and what I have to do today. It's quite valuable in that regard. So. But prior to just being a Medicare broker, I was working with Aflac as a district sales coordinator, leading a team. And prior to that, I was an optometrist assistant. Checking out eyeballs. So measuring the front and the back of the eyeballs. It's kind of neat. It's I'm fascinated about health and all. So that's kind of like my track of my life in about 10 seconds.
Oh, fantastic! So how long have you been kind of specializing in Medicare?
In about 5 years.
5 years.
So yeah, 5 years specializing in Medicare. I just have a really knack for it. I love it. Love talking to our seniors, answering some of the questions. And then we both live in America, and we don't even know the rules that we live here, and much less if you're not involved in it. Why pay attention? Why study those rules? But there's so many layers. It's like a little onion. They call it a little artichoke, peeling out layers and layers. It gets better in the middle.
Mm-hmm. Nice. What do you find most satisfying in your work?
I think like as an educator in the past, as a missionary, as district sales and all that, revealing something that's someone didn't know, bringing truth, bringing knowledge to someone, make it so simple.
Mm-hmm.
I think that's really valuable for me. It's like for me, it's clear. For you, what you guys do here at taxes, it's super clear for y'all. The rest of humanity, they may not know that, whether they just can't understand it or the rules are so complicated. And here's the A, B, and C's, all like, wow, that is so much. Why didn't they make it easier? Well, so bringing something complicated, making it simple, and making it chewable, where it's chewable pieces. And I think people really find joy in that. It's like, wow, you bring a lot of value.
Oh yeah, you're speaking my language now, Peter.
That's it. Yeah.
My goodness. So obviously taxes, there's a lot of misnomers and misconceptions and things that people think they understand that they really don't. And so the whole reason that this podcast even exists is because we're passionate about trying to clear that kind of stuff up. So oh yeah, you are definitely speaking my language. Okay, so let's go ahead and jump in.
Sure.
If you're good, we're going to be talking about a couple things today. So obviously, as a Medicare expert, I want all of those little nuggets, all of those clarifications that you can give us. We do want to talk a little bit about Social Security today, but as I understand it, you're really not in the Social Security field at all. And so we'll limit some of that to the tax ramifications of Social Security, which I can speak professionally. But if what you're really looking for is more when to begin drawing Social Security and how much am I going to receive and how many credits do I need and all that kind of stuff, really the Social Security Administration is actually a pretty good resource. Generally, I don't recommend talking to the government directly and their agents for a lot of things, but actually a lot of my clients have had quite a bit of success in working with the Social Security Administration. So I think maybe they're a little bit of a unicorn. I don't know if you have any thoughts on that at all, but it has been my experience that when I have sent my clients to talk to the Social Security Administration, they're actually pretty helpful. Have you found that to be true at all?
I compare the government as a library. And all the books, all the stuff's there. You really got to dig to the websites, but you got to talk to the librarian. Right? It's
Nice.
kind of that person where I know exactly what you're talking about, be it a tax expert, a financial person, a person who works, and they know exactly where to pull and quote, all that. So, I mean, it's a wealth of knowledge. You're going to have at it, So that's my experience. Same
Nice.
thing with Medicare. It's a library. Look for those librarians. So they're going to be most helpful.
Yeah. Okay, great. So let's get a couple of things out of the way for Social Security first, and then we'll jump really into your bevy of knowledge. A couple things about Social Security for purposes of the taxability of Social Security. A lot of people conflate 2 points of Social Security. Number one, there is a penalty, or you can be penalized at certain income ranges for how much Social Security you receive. Usually, it's really tough to unring the bell for Social Security. Once you turn that on, there are ways that you can pay the money back and kind of turn it off, but those are kind of difficult to effectuate. But what people conflate is the penalty for, hey, I earned more than what I was supposed to, therefore I receive a lesser amount, versus my Social Security is taxable as income, or at least a portion of it can be on my tax return. So Social Security, essentially at about $15,000 of income, other income besides Social Security, a portion of that Social Security can be included in your income for income tax. But it's based on a percentage, and it's a prorated scale depending on how much you earn, up to about $45,000 of income. Again, minus the Social Security itself. So you could receive $36,000 of Social Security a year and earn $14,000 outside of that Social Security, and none of it is taxable. But as your income increases, a portion of that Social Security has to be included in your income, and you do potentially have to pay some income tax on that. Now, there are a subset of Americans who have less than the income threshold and just are not required to file a tax return at all. Peter, one of the questions I get a lot is, at what age do I no longer have to file a tax return? And it's not an appropriate question because, I've got 3-year-olds that have to file tax returns, and I have 98-year-olds that have to file tax returns. It's not age-based. It is income-based. So everything is based on income. Depending on how much income you have, you may be required to file a tax return. So people conflate those two things a lot. I really can't advise people on at what income ranges they start to get penalized from the Social Security aspect. That's where I begin to send people to the librarian, right? To have them try and talk to the people that have that knowledge. And a lot of times, actually, if you're ready to turn on your Social Security, you can actually schedule an appointment to go sit down and meet with them. And they have all of the access at their fingertips on how to advise you on what your options are in regards to Social Security, how much it will be, whether you are penalized, etc. And so, not to cop out, but generally speaking, I can give you some baseline information, and then you really need to go and talk to the experts. A lot of people think that tax experts are government experts. Well, no, that's not the case, right? Or that we are, Social Security experts. I know enough to be dangerous, but I'm certainly far from an expert in regards to advising folks on Social Security. The reality is I usually send them to my father. So of the Molen and Associates, Ward Molen of Molen and Associates, he just turned 72 this year, and he's working on an exit strategy. So next year he's hoping to work only in a consulting capacity. but he happens to be of the age of which, with his technical expertise from tax, let's just say he's got very good insight into all of that. And so a couple things to be careful for there. There was a period of time in which there were some incredibly complicated and convoluted strategies for how to draw Social Security. And I think it was 5 or 6 years ago, if I remember right, they really eliminated some of the more complicated avenues of drawing Social Security. You can still draw on your spouse's Social Security, and your spouse can draw on yours, and that doesn't effectuate your own Social Security. And so there's still some complex strategies, but again, usually my recommendation is that you talk with the Social Security Administration directly in order to see what your options are. All right, so now some of the basic data points, at least from my perspective, of Social Security are out of the way. Let's jump into Medicare. Let me tell you just from my perspective as a tax advisor, and so for reference, I'm 36 years old, and the first couple of years that I was doing taxes, I've worked here in the business since I was 10, and so I was washing dishes and cleaning toilets at that age, but I was working in the business. As I began income tax preparation and really learning my craft, there were some things that I ended up learning about the hard way. And one of those was the increased cost in Medicare based on your level of earnings. And so what people tend to do is when they retire, they want to retire and have some stuff paid off. So it's the kind of the peace of mind and the quality of life of having the car paid off or the house paid off or whatever. And so from an income tax perspective, what I see a lot of is people retire and they want to take out X amount from their 401k, right? I'm sure you deal with this. And so they've already begun electing Medicare and Social Security, and they take out $100,000 from their 401k to finish paying off the mortgage. And that's a whole nother issue, because for income tax purposes, that's usually a terrible idea. But then suddenly they come back and they tell me, man, Kevin, after doing this, my Medicare went up by $200 a month or whatever. And I've learned the hard way to make sure to advise people, oh no, be careful taking this money out when you're on Medicare, because it's going to increase your payments. Can you speak a little bit about that?
Absolutely. So what we're talking about, the government has made an acronym called IRMAA, IRMAA. So it's Income Related Monthly Adjustment Amount. And that's a mouthful. In English, what that basically means is the more you made, the more you will pay. For what aspects? And so I'll just talk about now, and then maybe we can dive into a little bit later. So it affects Part B as in boy, and Part D as in David. So think of it like a 2-year wave. So the waves that you make today will affect you 2 years later. So you throw a rock in it, a big income source. Let's say, Kevin, you make $500,000 today. So that big wave, when you're turning 65 later, or this is after 65, 2 years later, that wave will hit you with the IRMAA. So we'll use numbers today in 2021. Part B standard baseline here is $148.50 for everyone. Kevin, myself, as standard as, let's say we're 65, right? However, 2 years ago, he dropped that rock that, he made a higher income. So that wave is much higher, and it will trigger the IRMAA, income related monthly adjustment amount, for both Part B and his Part D as in David. So both will be triggered. If he's below a certain amount, let's assume using the numbers today, he's single and he's only making $88,000 or less, it will stay at the bottom base, $148.50. Now that base will increase according to what he made 2 years ago. So the government has this handy chart. You look for your income, your status. Let's say you're single. Let's say I'm with a partner or whatnot. So there's certain categories, just like in taxes, you're familiar. Look for your income and look for your status. And the amount your Part B will surge according to that wave that you did 2 years ago. Now, let's say you did the wave, and that next year you lost a job, you change of income. You're not making $500,000. You're making, let's just say, $80,000, right? So obviously the wave has ebbed a little bit. So will my Part B and my Part D will maintain that higher status or higher IRMAA? No, it will drop according to what your wave would be 2 years in the past. So today, 2022 minus 2 years, what did you make in 2019? That's the numbers that they will look at. Well, how do I need to figure it out? No, the government already has it figured out because your wonderful tax preparer has already created that number, sent it to the government already has that on file. People say, well, I didn't file 2 years ago, so they'll just look back 3, if not 4 or 5, whatever the last number would be. They'll use that number against the chart, and then just look for your number, your status, and here's your amount. So you don't really need to tell the government what that amount is, and they already know. And of course, there's appeals. Some people do lose, like during 2020 with the pandemic, a lot of people lost their jobs, and all of a sudden their income decreases, but they maintain a higher IRMAA because of the ways they did 2 years ago. Those exceptions can be asked, and those are called the appeals that you can do for the IRMAA. So,
And what's the success rate of appeals?
I don't get to see on the backside. I'm never inside the government there.
Gotcha.
But hey, it's worth asking. Hey, mom, can I have an extra cookie? Maybe. So it's the worst they can say is no, right? If there's no justification. Of course, with the pandemic, that's a huge aspect in that regard. Change of incomes. There's a lot of list of things you can check off. The most common one is loss of income or change of income because of doing employer. So
There are scenarios in which, for income tax filing purposes, you can show income on a tax return that really isn't representative of money in your bank account. And so I'm learning some stuff today, which is great because I really don't deal specifically with Medicare almost ever. And so I really value your insight here. The times in which you're showing income, which really aren't representative of necessarily what is in your bank account, it probably is representative of your wealth, right? The wealth that increases. So, for example, stock sales, right? There are realized gains and realized losses. Owning stock does not necessarily, translate to money in your bank accounts because these are stocks that you own, not dollars. And you can have a very good year in the market. For example, 2020 was a great year if you were an astute investor to increase your wealth. And assuming that you bought stock at the right time and then sold stock at the right time, you realized gains. And then that money is now in some other form of stock or investment that may be a little bit more durable for purposes of a volatile market. And in that scenario, you recognize income on your tax return of which you're telling the federal government, hey, I had $500,000 of gains in the market. And you may have $3,000 in your bank account, right? So our appeals, let's see, how do I ask this question? I assume appeals are really for unusual circumstances, right? And I would assume that appeals are not accepted for purposes of, yeah, that's what my income shows, but that's really not what I have. Any insight there?
Usually the appeals are, again, I don't know what's on the backside. I just know they're more steady insofar as situations where I'm gaining 100, 200 every single year, and all of a sudden I gain 30. Usually it's a drop.
Gotcha.
They don't like to be, let's say my Part B, the highest bracket today, let's just say it's $504 instead of $248. So I'm paying $504 every single month, but between my partner and myself, we're only making as a household 30 grand. That 500 is a huge burden. So it's usually that drop, instead of like, hey, I cashed out, I got a big little lump, but I'm still working. Okay. So the easiest way to clear that is, and again, you can talk to your experts, whether it be in taxes or your financial advisor. How do I clear a bridge about 2 years so that wave, when it does hit it, it hits it low, not high? So again, that's not my area of expertise. I don't manage money in that regard. But if you can show in 2 years a span of time where your waves do hit your IRMAA at a lower rate, absolutely take advantage of that. So it's just that 2 years.
Okay, so interesting. So if I'm hearing what you're saying right, then you could have a high income year in the market, or for other reasons. There can be several reasons in which you're showing income that you're not necessarily receiving. If then 2 years later your income is lower, then you can make the appeal, not that this was an unusual circumstance, but that, but look at my income now. Okay.
So they'll be
great.
proactive with that. And again, managing money, not my forte, but I just know what happens on the backside. The government will look at microscopically 2 years ago, what did you make? And then I'm sure you know the line number, whatever it is on your tax return.
Adjusted gross income.
That one. They're going to look at that number, right? Whatever that number appears, they're going to take that, compare the chart, and then show you what your costs would be. So whatever happens in the interim, talk to your specialist to be able to lower that amount. Remember, you got a 2-year wave. You got to make sure that something happens during those 2 years so you can lower that. Anything between it, again, it's going to reflect the year after. So 2 years is your mark.
And that appeals process, is it very involved?
It is. It is involved. There's a form that you fill out, SSA, I believe it's 44. Usually it's a form. There's no way to fax it in. There's no way to email it in. You have to drop it off at the Social Security. So people are like, wait, 2020, all the Social Security offices locally are closed. What am I supposed to do with this? I'm like, yeah, mail it in and get hopefully it doesn't. it gets in the right hands of people. So things are opening up as of today. Few offices are open, but they're very swamped with a lot of work, and appeal is probably not high in priority. But when fast forward, they do have those offices. You have to handle them because they're very sensitive information on there. So the appeals have to be talked to the human, and they take that and look at what they need to look at to make it yay or nay.
Yeah. From an income tax perspective, when working with the IRS, really with appeals, you want to be talking to somebody anyways, right? Because you want to make it a human connection as opposed to something on the computer or just on a piece of paper. Because if you're a real person with a real sad story, for income tax purposes, you're more likely to gain some traction. I assume that this is similar. Okay, so switching gears a little bit, I mentioned earlier some of the areas in which the general population doesn't understand taxes or has misconceptions. And I'm really, really familiar with those. What I'd love to hear is from your professional perspective, where do they misunderstand or have misnomers in regards to Medicare?
Yeah, I would say approaching and then in it, right? So approaching the threshold of Medicare. Again, Medicare is health insurance for 65-year-old and older, with a few exceptions for those under 65, those who have been on SSDI or basic disability for more than 24 months. Certain illnesses do merit Medicare. We'll lump them all together. We'll call them 65 and older. As we all know, the exceptions are there. So 65 and older. So approaching that, what do I need to start? What do I don't need to start? That's one aspect. And another one's when you're already in Medicare or older than 65, you've had Medicare for several years, some of the misnomers while you're having, right? So we'll take it twofold. The first one would be scenario number one. Kevin still works, and he's going to work for another 10 years. He is 65, approaching 65 soon. What does he need to start? What does he not need to start, right? So in Medicare, there's two components. There's a federal component, and there's the private insurance component, right? Let's just focus on the federal, right? There are two parts, the famous Part A and Part B. In this scenario, Kevin wants to work for another 10 years. Does he need to start both? Yes, no, and I'll explain, right? So in this situation, his group health is considered a form of health insurance that does have, and it's a mouthful, creditable equivalent Part D for drug prescription plan. If his company does apply that, the creditable Part D Medicare, the prescription drug plans, then he can actually not get a Part D, which also involves he doesn't need it to get a Part B as an employee. He can delay that and not have penalties. Because what happens is if you don't have Part A and Part B and Part D as in David, when you're 65 and older and do not have group health, there are penalties looming around. And these are some severe lifelong penalties.
Penalties for not having those.
Correct.
Wow.
If you're not working, let's say, so it's just an arrow. I'm turning 65. I'm done with working. I'm approaching 65. And then, I just neglect to do my Part B as in boy, which doesn't allow me to get a Part D, as in David, for drugs. And I just go throughout the years without those two. Luckily, I didn't have to see any doctors. But I'm accumulating month after month, year after year, these lifelong penalties. And
now, real quick, you say lifelong.
Correct.
Meaning because you made that mistake once, you will pay that penalty every month for the rest of your life?
For the rest of your life.
Oh,
that's why
wow.
that's why when you're in it and you didn't realize it, red flag, come talk to someone, right? So the name of this is the late enrollment penalty for Part A. There's one for Part A is in Apple, Part B is in boy, Part D is in David. Now, Part A is temporary. So however many months or time that you had, double that. That's how long you're going to be in the penalty. Part B is in boy. Penalty works like this. A full complete 12 months is 10% penalty. So let's say, after 1 year, you realize that, oh my gosh, let me get Part D, or B is in boy, I got it at the proper time. Phew, I got it. That 10% doesn't grow anymore. You just now have been tagged for 10%. 2 years, 20%, 3 years, 30%, etc.
Meaning the cost of Part B increases by 10% for the rest of your life?
For you. So let's imagine you're in the lowest bracket, $148.50. Back to math class, move the decimal over.
Mhm.
So now you're paying an extra
$15.
$14.85 for the rest of for every single month for that year. Guess what happens to Part B? Inflation, it goes up. Well, now let's just say it's $15 or $150. Now instead of paying $14.85, it's $15. And next year it's $16, $17.
Wow.
However much inflation is, that's what you get. Luckily it's 10%. I call it the bleeding stops, but there's still a scar there, right? So you'll be tagged with a scar for the rest of your life.
Yeah.
And so some people ask, well, how do I get rid of that? Well, there's some unfortunate solutions. You can either move to Canada or, go out of state, or, well, you can just not have anything, live under the radar, or, I stop there. And usually when I do a seminar, some guy that there's another solution. Like, yes, sir, what is that? You can also die. Well, no, we're not going to go to that solution. But then, there's some unrealistic solutions. But unfortunately, you're tagged with that. If you're tagged with a Part B penalty, chances are you're also tagged with a Part D's and David. So that late enrollment penalty, it doesn't work for the full 12 months. Let's say you do it 9 months, you don't trigger the Part B. But for Part D's and David, what is this? It's 1% for every month that passes if you've gone beyond 63 days. So let's say you do January, no drug prescription. February, no drug prescription. March, you pass 63 days. And now that's 3%. April, May, June, July, August, September. A gentleman that I met had 5 years without a drug prescription plan. 12 times 5, he had a 60% penalty, 60% of what? So the government used this thing called an average base premium, and roughly today it's about $33, right? So 60%, $33, let's just say it's $17 or so. $17 every single month for the rest of his life. That number increases to $18. So it's a waste of $18 every single month because you triggered that late enrollment.
And that one you're referencing is D as in David?
Correct. That's a drug prescription.
And assuming that is being kicked in on D as in David, you probably are also experiencing B as in boy.
No, and not necessarily. It's A and B is the foundation. You cannot get a D without A and B.
Mm-hmm.
So if you had a D, some people do have an A and B, and they just forget or they don't need it to have a Part D. In that such scenario, they don't have a penalty for Part B or A. They do have for Part D. Mm-hmm. But if you had a Part B, chances are, because you're sitting on that foundation, you're triggering Part D. So those are the things you need to watch out for, because at the threshold of approaching into Medicare, does Kevin need to get a Part B or yes or no? So an expert like myself, what we do is we take the group health. Let's lay it out really quick here. What are you paying every single month? What are you getting? And what's your deductible? So these are your hurdles. If the hurdles are small, and let's say the company's generous, we got the entire premium. So he's paying nothing. His deductible is low. So he's got a very small hurdle, and his plan's phenomenal. I said, I can't stand that plan. Why? First of all, you're not paying anything. The plan's is really good. So you're getting a lot for very little. Let's ride that out until you decide to terminate your job. And hence, usually the job is terminated as well with benefits. At that time, then we'll go ahead and jump into Part B. Why? Why wouldn't he just stay in group health and also have a Part B? He's now paying 2 card payments. When you go to the doctors, you can only hand him 1 card. Right? You can't double that. So you're technically losing money on both sides. Unfortunately, he doesn't have to pay in this scenario for his group health, but he's still paying $148 every single month. So if you're not going to get a penalty and you're not going to be able to use it, we'll go ahead and delay that. Okay. Flip that example. Let's say it's a terrible plan, right? He's paying $1,000 just for himself, and a deductible of $7,000, and the plan is not very good, right? It's a very expensive plan that you're paying for, and it's very weak. For him, at the threshold of 65, we'll say you can continue working here, but my suggestion, my advice is take a look at what Medicare is. You're paying $148. Let's say you want to put another supplements in there for the sake of just education. I can't go into the details of the private insurance. But let's say you tack that on, and it's a lot lower than $1,000, and it's a lot stronger. Now you're weighing your costs. Do I pay a lot for something weak, or do I pay something that's kind of average and understandable for something very strong? Well, the choice is very clear. Having group health, having Medicare, it's not saying should I work or should I not work. Those are separate, right? You can opt into Medicare and still continue to work at that company. So a lot of people equate working and benefits are one and the same. When you become 65, you do have options to like stay with the group health that's offered by my employer, or should I go on Medicare? I don't know. You don't know. You need to see, lay everything out flat, and then we can deliberate, putting things on both sides, pros and cons.
And is that what your company does?
That's what I do. Yes, that's what I do. It's an extra step, but it's so important because it's almost like playing poker. Should I fold or should I stay? Well, let me take a look at your cards. Let me take a look at their cards. We'll say, well, look, who's going to win here? Are you going to win at the end of this? And then they might say, well, another component to throw in there is, well, I might win. That's great. Do you have a spouse or a partner? I do. How old are they? Well, they're 60. Well, what happens to them? I never thought about that, right? So you might be fine. You might have wonderful benefits, but for those next 5 years, what happens to her or him? We never think about that. Yeah, she's part of that card as well. So even though you might be fine, but that depends on you for that health plan, that becomes a huge issue. So then usually the spouse says, "Can you work for another 5 years?
Yeah,
I'm done with this job."
Yeah.
That's a life, family conversation.
So one other question I had for you. Let's say that I have a friend or a family member who is turning 65 next year. And I only know what you've talked about today so far. And so I know, oh shoot, they need to be worried about potentially getting penalized. Lifelong penalties. Lifelong penalties, those type of increases, especially at the mercy of inflation, because those penalties increase based on the nature of inflation and with how much money the government is spending in 2020 and 2021. Inflation is a big worry, right? If that doesn't raise the rates, and if we keep pumping money into the economy, inflation is going to go wild. We're already seeing the cost of commodities increase dramatically, right? So from a financial perspective, inflation is absolutely a worrying piece. And these penalties increase based off of inflation. So let's say I have a friend or a family member who's turning 65 next year, and they really don't have a handle on this. What do I tell them? Just as I'm not an expert. Here's your warning. What do I say to them?
There's two things I would do. My time frame for educating our seniors, I would pull all the way back to when they turn 64. 64, blow out the candles, call the person, right? So that's one thing, is that use that time frame, because the government does have about 6 timelines. The timeline that situation is, it's going to be 7 months. So let's say they turn 65 today, right? Today is going to be July. That's month 4 of 7. So the government allows you to have 3 months prior to 90 days prior to July 1st, and all the way as well 3 months after July. So that's August, September, October. So basically holidays. That's the long time frame. So during that time frame, when you're in it, some people don't realize that they have to make moves and move things around. So when that introduction started month number 2 or 3, we're rushing. And usually at that age, you don't want to do things quick, and especially with the government not being super fast, they need some time to process as well. So at 64, give them a whole year. 2 things you could do is, one, you can give them the tools to say, here's a website, here's the book you can do, be aware of those penalties. That's all I know, and that's all that you're able to convey. At least give them some tools to work with, right? The other one as well would be introducing them to a Medicare specialist, a Medicare broker, people like myself in that regards, during that year, sometime during that year, because sometimes, the circumstances, we just came to find out last week. As a broker, we also have rules with our government as well. As licensed representatives, we cannot initiate first contact. We cannot solicit. So let's say I find you look old, we should talk. That's illegal, right? So we, obviously for obvious reasons, protect our seniors, right? So say your friend, your neighbor, and say, look, he can't reach out to you, but you should give him a call. And it's at the at the liberty and the deliberation of that senior, whether they want to call or not. But that connection is going to help a lot, especially with a broker who's able to pan out, like I said, what do you have with health? Here's how Medicare works. Let me show you how Medicare works. And the method I use is very, very simple. There's two things. One's to educate, and the other's to advocate. So everything I know, I want to make sure that you know. I'm going to give you all the tools that I use, so you know the penalties, you know how it works, and what the components are, what the options are. So now that everything's all on the table, I'm going to now advocate. What are your doctors that you prefer, you've seen for years, you don't want to change? What are your medications that keep you alive and healthy? Give me all those. Great. What's your dollar disposition? Well, my pocket's nice and thick, or my pocket's thin. I don't have a lot to work with. Let me include as well your debt. So those are the 4 Ds I work with. Now I can start advocating. So we can start eliminating certain options. You see, we're not going to go there, right? They're like, yeah, because you give me the tool to understand it myself. We're going to focus on things that make sense to me. Let's take a look at these. Let's shuffle them a little bit. Here are the most suitable 3 options. Why don't you talk about that with your family, your spouse, and all that, and then we'll come to a decision. We'll move forward. That's the method. Very easy in that regards. I don't want to just give them a fish every time and say, well, next time you need a fish, call me up. No, I'm going to teach you how to fish. You learn the rules, and then from then they have that peace of mind. Just like you guys do. It's that peace of mind, the understanding. I know the country that I live in, the rules that this country makes.
Yeah. Fantastic. So before we move on to our next segment, any final pieces that you came in today just saying, I'm going to make sure I give Kevin my viewpoint on X? Anything that we've missed so far that you wanted to make sure we talked about?
I think you covered a lot. I think one of the things that you that's out there, because remember we did talk, a lot of people didn't know about this, right? The ignorance is out there, and the knowledge is all tucked in the corner. Anytime you come across someone who's 64, there's always that something. Do you have a broker helping you? They may say yes, they may say no, because what happens is a lot of companies and carriers, they get very creative in their ads and marketing. You see that TV, the mailbox always full with a lot of ads. It's very misleading. All those things are true, but again, you're highly marketed. So there's a lot of confusion out there. So my takeaway would be anyone who's 64, make sure you do make the effort of reaching out to them, make sure they're okay. Why? Well, if it's choosing between a caravan or a car, that's no big deal. But when you're dealing with something that does have sanctions that are lifelong, that's things. The same thing with taxes and with finances and preparation. When they have a longevity of the consequences and results, that's do the favor there. So that's what it is.
Yeah, fantastic. Thanks so much. I've really appreciated your insight. So let's go ahead and move on to our next segment. Usually the way that we will end out most of our episodes is we go through something called the comfort zone. The comfort zone is just us ready to hear questions that we have not heard prior to our discussion today. So Clark, our producer, can catch us by surprise. Clark, do you have some questions for us today?
Yes, I've got a few for you. I'm going to throw you an easy one first, get you warmed up.
Softball, huh?
Yep. So the first one, you mentioned Part A, B, and D. What are the different types of Medicare? Can you explain them just very briefly?
Yep. Very, very simply, see it as 2 components, federal and private insurance carriers, right? It's like motors and wheels. You need to have both. They work together, but they're very different. So Part A and Part B, it's federal. Part A covers inpatient care. Part B covers outpatient care, with the exception of dental, vision, and drug prescription plan. These have holes in it. They're not complete. Part A covers for 60 days. It's time coverage. Part B covers a percentage, 80%, 20s on you. So you see the holes there, right? Here comes the private insurance company. And the private insurance company is broken up in 2. It's a fork in the road. You can have one or the other, not both. None of these are available without the foundation of Part A and Part B. What's one? One is going to be actually Part C. So Part C is Medicare Advantage. The other option is Medicare Supplement. Very, very different. They work kind of like opposite of each other. And with Medicare Supplements, you do need to tack on the Part D as in David. With the Medicare Advantage, usually that Part D is in David, the drug prescription plan is kind of built in. It's already built in. So those are the big options there. Do I want to go one? Do I want to go the other? How do I know? That's where when I come in to analyze that aspect there. So the components again, federal, private insurance. The federal has Part A and Part B. The private insurance has Part C, Medicare Advantage, drug prescription, Medicare Supplement tacked on with the drug prescription. So hopefully that's a little thing right there. 10 seconds.
Perfect, thank you. Next question. What is the difference between Medicare and Medicaid?
That's a really common one. I wish they made it two different letters, right? So Medicare, think of caring for someone who is ill or unhealthy. It is medical, meaning that is your health insurance program, 65 and older, right? Medicaid, and the way to think about it is the last part, aid. Hey, I need some help. Why? I'm hurt for money, right? So I asked Texas, hey, look, here's my income for the last 5 years. You got to prove it. I need your help, Texas, to pay for some of this. And actually, some of that payment can also be paid for my thing that helps me take care of my health, my Medicare. So one person can have Medicare and Medicaid. One helps with my health. One helps with me paying for that health plan. So people can also have Medicaid alone. For example, those CHIP programs for the children. That's a form of Medicaid. It comes with the federal or the state of Texas. They pay for that. So one is economic, one's health.
Awesome.
Yeah.
Okay, last question. How do our listeners contact you? How do they learn more about you?
So, like, again, we have that rule there. So the easiest way to contact me, you guys can always go to the Molen Associates, but I usually work with my cell phone and my email. Make it very, very simple. I do have a website and all the booking sites and all that. I think it's really millennial bougie, complicated, but okay. Right? Again, cell phone and an email. I guess y'all tack that on at the bottom.
Yes, we will. Yeah, we'll include that in the description below, and maybe Clark will be able to put that on the screen for us. Make sure that people who are watching this are able to receive that information. We certainly don't want to get you in trouble for purposes of selling, and I can appreciate why that exists. But we also want to make sure that our folks who are getting some value from hearing you today are able to reach out to you. I, for one, am going to make sure that I have your contact information handy because I see hundreds of people every single year, and many of them are or at least a section of them are in that age range that they may need a broker's assistance. So. All right, fantastic. Really appreciate, Peter, your time today. Really appreciate you joining us. This has been very informative, very helpful. I certainly have learned several things that I'm then going to be able to not teach, but warn people about to make sure that they get in contact with you. So thanks so much. Really appreciate your time.
Thank you for having me here. This is a wonderful setup. You guys did a great job. I'm a personal client of the Molen Association, and this is not what you asked for. I'm going to say it anyways, but they're very, very good, and they've been very hospitable to me in my circumstances. I need these papers, and they're very good at that. So I can associate with their level of services because that's the way I treat my seniors as well. So they're very good in that regard. So I appreciate you guys, and if any way I can help you, your seniors and whatnot, and educate as well, knowledge of nuggets of knowledge there.
Appreciate that. Shameless plug, huh? Well, we will definitely return that favor. Thanks so much, folks, for listening and for watching. Really appreciate your time. Hopefully you've learned something new. And as always, make sure you tune in next time. Thanks so much.
Thanks for tuning in to this episode of Questioning Your Sense. If you haven't done so already, be sure to subscribe to this podcast, leave us a 5-star review, and don't forget to share it with a friend. If you would like to submit a question for our review on this podcast, feel free to email us at info@molentax.com.